Hey guys, I'm Bill Losey, America's retirement strategist, and if you give me just a couple minutes of your life, I'll give you 20 years of mine. Today I'm going to talk about 7 reasons why the stock market is so volatile again. I'll get to that in just a second, but first a moment to tell you who I am and why the heck you should listen to me. In case you don't know me, I'm the former resident retirement expert on CNBC's On the Money. I'm also the author of Retire in a Weekend, The Baby Boomer's Guide to Making Work Optional. In addition, I'm a highly sought-after speaker as well as a guest expert on personal finance, radio and TV programs nationwide. But finally and most importantly, I've been counseling people just like yourself for about the last 20 years. So it's no surprise that over the last 3 weeks we've seen some extremely volatile swings in the stock market. We've seen the major indexes, drop anywhere from 10 to 15 to even 20%. So I wanted to talk about the reasons behind the drop. Number one, I think you have to go back to March of 2009 when we were at our all-time lows. And as of April 2010, we actually had 14 months in a row of a positive stock market. So reason number one for the volatility is that we were due for a pullback. We'd become overvalued again, and we were due for a correction. In fact, it was long overdue. Reason number two, the markets are so volatile, jobs. Unemployment last month actually ticked up again when people thought the job market was getting better. At this point, there are still 6 people looking for jobs for every 1 job that's available. So it's going to take years till we get back to full employment. Number 3, housing is an issue. Although we've seen housing starts go up and home sales increase, a lot of that had to do with the tax incentive to do it by the end of April, which has now expired. There's also a lot of homes that are not in foreclosure yet. It's called the shadow market. They're going to be coming onto the market later this year, and a lot of economists think that we could actually see round 2 of price decreases in the real estate market. Problem number 4 or number 5 is the credit markets. Remember when we had this whole issue back in late 08, 09, lending seized up. Well, banks are a lot more liberal with their lending than they were just a year or year and a half ago. But the fact of the matter is they're still not lending out the sums of money that they used to, especially to small businesses. Small businesses, of course, the engine of the economy, they're the ones that hire the most workers. They're not hiring workers because, 1, they can't get the loans, and number 2, they're concerned about federal regulations. Another big reason why the markets are so volatile, people are concerned about all the money the government is spending. At some point, the money is going to have to be paid back. And right now, there's only a couple ways it's going to be able to get paid back, which is 1, increase taxes on all of us, and we're going to have to suck it up and probably deal with that. And number 2, they're going to have to cut spending, and of course that remains to be seen whether or not the politicians in Washington can actually do that. Right now, what's really moving the market is the whole mess up over in Europe, and also with Greece, who had some riots there a couple weeks ago. They passed some austerity measures. They were on the verge of bankruptcy, but the EU and the International Monetary Fund, gave them over $1 trillion to stabilize that economy. But what you have to recognize is that all of these economies now, our economy, Europe's economy, Asia's economy, we're also interconnected. And when one has problems, it affects the rest of the world. And finally and lastly, I would tell you why the markets are so volatile is that the markets really only move for 2 reasons. I just gave you 7 reasons, but the primary reasons the markets move are greed and fear, and right now we're definitely in a period of fear. But the bottom line is when the markets go up, they don't go up forever, and when the markets go down, they don't go down forever. You need to be in it long term if you want to have the possibility to keep pace or outpace inflation. So I hope you work with a trusted financial advisor and can get your ducks in a row and can deal with this volatility. Listen, if you found this information helpful, I invite you back to my website. There I have a free 30-page report you can download called The 10 Biggest Mistakes That People Make When Retiring and How You Can Avoid Them. For you folks very nervous about investing, I'll also share my investment philosophy. I've got a program called What Wall Street Doesn't Want You to Know, where I talk about the best way to invest. All you have to do is come back to BillLosey.com. That's BILLLOSEY.com. I am Bill Losey. I appreciate you. I thank you so much for watching, and I'll catch you back at the website. Take care.